$90 billion. One family, one office above Fifth Avenue, and a brand they refuse to take public. The family is Wertheimer. The brand is Chanel. The office, 36 staff in Midtown Manhattan, is called Moose Partners. Almost nobody has heard its name. To understand why a fashion house pays a New York investment firm to manage its owner's money, start with one bet at one-horse race. 1922. Longchamp. Galeries Lafayette. Founder Théophile Bada introduces Coco Chanel to two textile brothers, Pierre and Paul Wertheimer. 2 years later, they sign a contract. Wertheimers take 70% of Parfums Chanel. Bada takes 20%. Coco keeps 10%. A century on, the grandsons, Alain and Gérard, own 100% of everything. Bloomberg pegs each of them at roughly $41 billion. The vehicle is called Moose Partners. It was set up in 1991 by Charles Heilbronn, half-brother to Alain and Gérard through their mother's second marriage. Heilbronn spent decades inside Chanel itself as an executive. Then he was handed a separate office with one job: invest the cash dividends pouring off the brand. The headquarters is the Solo Building, 9 West 57th Street, Manhattan. Same postcode as Apollo, KKR Partners, and a wall of hedge funds. Roughly 36 staff. Pedigrees pulled from Carlyle, Singapore's sovereign wealth fund GIC, and Soros Fund Management. Satellite offices in Beijing and Hong Kong, added in the 2010s to source private deals across Asia. The mandate is wide: private equity, venture, real estate, public equities, fixed income. The discipline is patience, multi-decade hold periods, not quarter by quarter, and critically, the firm is built to be invisible. The corporate website contains almost nothing. The first serious profile, a Bloomberg professional feature, only landed in 2024. Until that piece, most luxury analysts could not name the office, the founder, or the address. One family office, one half-brother running it, 36 staff above Fifth Avenue. And a balance sheet bigger than the GDP of Bulgaria. Moose is estimated at $90 to $100 billion in assets under management. A material chunk is the implied equity value of Chanel itself. The rest is real money invested everywhere else. The signature trade, Moose backed Ulta Beauty before its 2007 IPO. By 2021, the position had returned over 1,700%. Moose sold roughly $480 million in stock and kept about $150 million in residual exposure. Other confirmed names: Coty, the cosmetics holding company; Beauty Counter, the clean beauty brand, capitalized in 2018; 66 Degrees North, the Icelandic outerwear label; 30, Madison in healthcare; Store in e-commerce; Evolved by Nature in biotech; real estate across Manhattan, London, and Geneva. And in February 2023, Moose was reported as one of the co-investors in the deal to take Rothschild & Company private, alongside the Rothschild family itself. Then 2024. Bloomberg Linear reported the Wertheimers extracted a $5 billion special dividend out of Chanel. Combined family net worth crossed $90 billion for the first time. Ulta, Coty, Rothschild, Manhattan Towers. The portfolio is the brand's twin, and almost nobody outside the office sees it. For most of the 20th century, nobody outside the family knew what Chanel earned. The company was structured through a Cayman holding entity, then a Dutch one. Operating subsidiaries filed locally. Consolidated numbers existed nowhere public. That ended on June 21, 2018. The reason was prosaic. The UK changed its Companies Act. Large entities incorporated there had to publish consolidated group filings. Chanel's UK holding company crossed the threshold. Suddenly, the world had global numbers. The reveal was staggering. For 2017, the first disclosed year, revenue was $9.6 billion. 5 years later, for 2023, revenue had more than doubled to $19.7 billion, up 16% constant currency. Operating profit, $6.4 billion. Net profit, $4.7 billion. Operating margin, roughly 32.5%. The publicly traded comparable, LVMH, ran an operating margin closer to 26% the same year, on revenue of 86 billion. Chanel, half the size, earns more per dollar and pays none of the IPO compliance cost. Headcount year-end 2023, about 32,500. CapEx, 1.227 billion, 6.2% of sales. So why no IPO? A public listing forces quarterly disclosure, dilutes control, adds zero capital the family needs. Moose Partners exists to keep it that way. Most family offices exist to grow a fortune from one source into something diversified. Moose Partners exists to do that, and to protect the source from the investors it competes with. Chanel could have been sold to LVMH for a figure no analyst could write down without giggling. It has not been. Chanel could have been listed at a valuation north of 200 billion. It has not been. Instead, since 1991, every dividend the Wertheimers pull from the operating company gets pushed sideways into Moose, into Ulta, into Rothschild Equity, into Coty, into Manhattan office towers, into Beijing real estate. The brand is not the portfolio. The brand is the engine that funds the portfolio, and the portfolio is the moat that lets the family say no for one more generation. Next on the hidden ledger, you pick. Thread 1, De Beers. The diamond cartel, Anglo-American, wrote down by billions last year, now trying to sell while lab-grown stones eat the bottom of the market. Thread 2, the Arnault succession, 5 children, 1 LVMH. A holding structure designed to crack. That might not. Drop a comment with which one you want first. Subscribe so the next ledger lands in your feed. Every week we open one more.